Welcome to the Confident Dollar Podcast, where we are seeking to bring confidence and organization to your financial life. Hey, and welcome back to the Confident Dollar Podcast, where we are always seeking to bring confidence to your finances, specifically through education and helping just teach you about the investment world in a way that you can understand and a way that can benefit you when it comes to how you manage your money. So, my name is Lauren, and on today's episode, we are going to be talking about one of the questions I get pretty often when it comes to new investors, and it is the confusion around what is an index fund, a mutual fund, and an ETF. So, we are going to go over those three things, explain each of those to you so that you can finish this podcast episode understanding those better. So you can understand your investments better, whether you're doing it yourself or you're DIY or you have hired someone to help you manage it. At least you know what's going on. So I am going to walk you through those three things, because if you've ever felt like those are thrown around interchangeably and you've wondered which one's best for you or what means what, you're not alone. Again, a lot of people have a confusion around these three and what they are. So by the end of this episode, you should be able to know what they are and how they might work for you when it comes to your investments. So, first, let's start with the basics of what these are in general. And index funds, mutual funds, ETFs, they are all a different way of investing. They're investment funds, an investment vehicle, a way that you can put your money to work for you to invest in the stock market or bond market to make money. So that's the goal with investments, right? To grow your money while you're continuing to work and save for retirement, save for a house down payment, or whatever your long-term goals are. You are picking investments to help your money grow. And these are the common type of investments that people pick. So they are all a diversified basket of investments. So you put your money in the pool, and then whether it's an investment manager or a passive style, which I'll explain later, but that money is then divvied up into different stocks or bonds, depending on the type of investment you're picking, and diversified amongst the entire basket. So it is a way to own stocks without having to own individual stocks, which can be more risk oriented for your investments because you're putting more of your money in one thing. So the whole saying, don't put all your eggs in one basket. You own one single stock. Obviously, you're not very diversified and you're dependent upon how that company does. With a mutual fund or an ETF, you are diversifying amongst a bunch of different companies and stocks within that investment. So it is a helpful way to diversify and a great way to invest, depending on the account and what your goals are and all of that. So let's first start with explaining a mutual fund. Again, it is pooled money. So that's where that mutual comes from. It is everybody's putting their money together. It is a mutual investment. And then within mutual funds, more often than not, you are having a professional or a team of professionals are taking that money and they are investing it into different companies. Now, specifically what they're investing in depends on something called the investment objective of that particular fund. So the investment objective, I like to describe it as like the theme of that fund. If the theme of that fund is growth and that fund is trying to grow, then your professionals or the managers within that fund are going to look for good growth companies to invest in. If it is a dividend paying fund, then they're going to look for good dividend paying in companies. So companies that pay out income to their investors. So depending upon the theme of that fund, those money managers are going to take all the pooled investments and they're going to go out and pick the companies that they think that they should invest in, depending on the theme of that fund. Oftentimes, they go meet with the company, they go on the ground, they meet the managers, the CFO, the people within the company. They look at the books and they see and they help verify if that is a good investment for their investors that have purchased their fund. You can do different mutual funds through all sorts of different mutual fund companies. There is a large array of mutual fund companies to choose from, and also a large array of investment objectives to choose from when it comes to specific mutual funds. So the same thing where they buy stocks, you can also have bonds. So mutual funds that are bond funds, that are short-term bond funds, long-term bond funds, intermediate, muni bonds, again, different types of bonds and different types of funds depending upon the investment objective of those bonds. So one of the pros is they are professionally managed. So you can leave your money up to the professionals who know more than you, who know more than me, who are, again, meeting with people. They're putting, the boots on the ground to go see these companies and see if they're the right type of investment for their investors. But you are going to pay more for that professional management. There is normally a higher fee within mutual funds than ETFs or index funds, and we'll talk about that. But they do have a higher fee within, which is called an expense ratio. So it is a fee you will never see, but it is taken off the investments, kind of the returns before they're sent to you. So, but essentially you are paying for it, though you won't see it specifically deducted from your investments. It is wrapped up within the mutual fund itself. So because you have the professional management, they do normally have higher expense ratios. But they can invest, like I said, in stocks or bonds or both. You might have a balanced fund that's stocks and bonds. And depending upon how the fund's set up, those managers have a leeway to go back and forth of how much stocks and how much bond in that balanced fund, or if it's an international fund, maybe how much domestic to how much international, and they have a range that they can pick depending on what they see that's going on in the economy. Oftentimes you will see mutual funds within your 401ks, though when I help clients lately, I am seeing more and more ETFs within 401ks, but they almost always include mutual funds for sure because they've just been around for so long. Like I said, one of the drawbacks is going to be because you have, you're paying for that professional management. They do oftentimes have higher expense ratios and higher fees. Another thing to consider with mutual funds is they are only priced one day. So they are priced at the end of market close. They do not trade on the market during the day. So you don't have the flexibility to really time the market as, easily throughout the day, though you will get end of the day closing price. And again, they're only priced once a day when it comes to mutual funds. And then some mutual funds do require a minimum investment. Again, it depends on the fund and the fund company, but it is something to look for when you're looking at mutual funds. So again, basket of stocks or bonds or both, depending upon the theme of that fund, professional management. They only trade once a day at the end of the day, and they normally have a higher expense ratio. So that's the gist of mutual funds when it comes down to it. I want to jump to ETFs because I'll explain to you a little bit more about index funds after that. But I first want to explain ETFs, which stands for exchange traded funds, and kind of explain, now that you might understand mutual funds, explain what the difference would be between a mutual fund and an ETF. So again, stands for exchange traded funds. They are similar to mutual funds in a lot of ways. It is a pool of investments that is then diversified among different companies for the specific investments. So same thing, you're still pooling your money together, but there are a couple key differences when it comes to ETFs and mutual funds. Oftentimes, like we had talked about, mutual funds have those professional management. And actually, I'm sorry, I'm going to jump back for a second. I did not clarify that with that professional management, mutual funds are most often called an actively traded investment strategy. So those professionals are able to actively change up the investments within the mutual fund depending upon their expertise and what they see going on, again, in the economy or in specific companies. And so that is called active investment strategy. Again, that's what you're paying for. And they can change that up. With mutual funds, when they do that, when they sell different companies within the mutual fund, they have something called capital gains that are passed through to investors. So they aren't the best tax efficient strategy within a taxable account. And that might just really throw you for a loop on confusion. But I wanted to preface that and go back to that for a second, because that does matter when it comes to discussing ETFs. So ETFs are different in mutual funds in that they actually can normally come with especially lately, there's two different types of ETFs. You can have a passive ETF strategy or an active ETF strategy. So you can have a professional management that within the ETF that is doing an active strategy of buying and selling different companies, depending on, again, what they see in the economy and what they see in the specific companies. But previously to more recently, most ETFs have been a passive strategy. So it's called buy and hold. They are taking your money within that ETF. And again, the theme of that ETF, they are going to purchase a certain basket of companies and they are just going to hold on to them. They aren't going to change up the companies that they hold in there. That is a passive strategy. A passive strategy is going to be less expensive when it comes to your expense ratio because you're not paying that money manager to use their expertise to try to change up the investments. You are just buying and holding those companies no matter what within that ETF. Again, there are ETFs more recently that have an active strategy. So they're doing the same thing as mutual funds. The difference of those, again, with ETFs, with mutual funds in general, is that ETFs are able to trade like a stock intraday. So that means during the day on the market, you can buy and sell ETFs in that, that minute or that second that you're trying to do that. They trade throughout the day instead of just that end of the day closing price. So again, one of the pros is that ETFs do normally have a lower expense ratio than mutual funds. Even the ones that I've seen that are active ETFs do have a lower expense ratio more often than not than mutual funds. But the passive strategy for sure will have a lower cost than most mutual funds. Again, they can be traded on the open market. That's a pro. There's not normally a minimum investment for an ETF, and so they're easy to get into, easy for beginning people who are just getting started with a less amount of money. They can get into ETFs, and they are more tax efficient for taxable accounts. So I jumped back to talk about that tax efficiency in a mutual fund for taxable accounts, how they're not very tax efficient, and capital gains are passed through to the shareholders of the mutual fund, depending upon how they sell within there. ETFs are not the same. So ETFs have a different taxable way that they are coded within the fund themselves. So even if they are an active strategy and they are buying and selling different companies within the ETF, they are still tax efficient for investors. Capital gains are not passed through to the investors on even an active ETF. And then a passive ETF is not going to have that because they're not selling and changing up the investments. So they are more tax efficient in that way as well. The downside of an ETF, really not many downsides. One would be someone might be tempted to trade, try to time the market too much since they are traded on the market during the day. But, I don't really see that as being a huge downside. They're a really great investment strategy to use, especially within taxable accounts. So then let's come back to index funds. If you hopefully understand or have a little bit of the information around mutual funds and ETFs, what is an index fund? So an index fund can be a type of mutual fund or a type of ETF. So it's not specific to like an ETF or a mutual fund where it's its own thing. It's really its own strategy. So where the mutual fund had the professional manager in an active management that is looking for different companies to invest in and changing that up. The ETF we talked about had either the passive investment strategy of the investments that it wanted to hold on to, that buy and hold strategy, or like I said, newer ones now that are coming out that are active ETFs. An index fund, whether or not it's a mutual fund or ETF, an index fund is going to specifically track an index. So it can be a mutual fund that tracks an index, or it can be an ETF that tracks an index, but it only tracks an index. So again, it is, let's say it's an S&P 500 index fund. It is tracking the S&P 500. It will hold the investments exactly like the S&P 500 has. It will hold that the same within the index fund, and it will track that. It might track the NASDAQ. It might track a Russell. It might track a different market, but it will track a specific index. And that is what an index fund is. So depending upon if it's a mutual fund, index fund, or an ETF index fund is going to depend on if it trades intraday or not. And what it will have though, whether or not it's a mutual fund or an ETF, will be lower expense ratios really in both ways, because again, it's just, it's passively managed. It's a passive investment strategy where it's just tracking an index. Nothing else is going on in there except tracking that index. So it's very simple. It's very diversified for the most part. And it's just doing that whether or not it's a mutual fund or ETF. So you can find both. So again, that index fund is really more of a strategy than it is a specific type of fund, different than a mutual fund or ETF, since it can be both. And I've seen it as both. They might, again, depending upon if it's a mutual fund or ETF, it might have minimum investments, it might not. But what it will not do is it will never beat the market. It will always just mirror what the market's doing. Now, I know there's been a whole lot of, information pushed out of whether or not mutual funds beat the market anyways. I would say from my experience, it really depends on the mutual fund company that you were using and depends on the market. But what you will not get in an index tracking fund is beating the market. It will just mirror the market no matter what's going on, minus fees. So if you're looking for something to outperform the market, you would look outside of an index fund. So each of these can be used in different ways, in different strategies within your investments to really complement each other. So I think that each of them can have a role to play within your investment strategy, can have, a way to utilize each of them. So I'm not someone that says I'm all mutual funds, I'm all ETFs, or I'm all about an index tracking fund. Definitely not. I use each of these in my clients' accounts dependent upon their goals, their type of account, and the strategy within them. So they all can have a place within your investment strategy if you understand them. Like I said, they're great. They're all great tools to use depending upon what ones we're talking about. There are some I like better than others. But again, in general, they can all be a tool that can be used within your investment strategy. So I hope this is helpful to explain these three to you, to get a little bit more understanding of what they are, and start to kind of wrap your mind around how you could possibly use them, or which one you'd like to look into more to see what you would like to use. So if this episode was helpful for you, I do ask that you maybe, share it with a friend, or leave a review, or just hit the follow button, because all of those are very helpful for me in being able to reach more people with this financial education so that they can continue to grow more confidence in their finances. So thanks for joining us, and I look forward to our next episode. Have a great day. Lauren Gage is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including loss of principal.